Hello everybody. We are going to see financial statements. Friends, in modern accounting, when we say financial statements, it includes two important financial statements. One is position statement, that is balance sheet, which reflect assets, liabilities and capital of a business entity on a particular date. It shows the financial position of that business entity on a particular date. On the other hand, other statement is called income statement or vertical profit and loss account, we can say, which shows the financial results of a business operation during the particular period. Now, this profit and loss account or income statement and balance sheet or position statement are usually shown in vertical form, which is better for analysis in management accounting. Financial statements, also known as the package of financial statements. This income statement and balance sheet or position statement is supported with different schedules, annexures and footnotes. These supporting schedules and annexures are considered very much part of that financial statements. The financial statements are summarized reports of accounting transactions. They are prepared for the purpose of presenting a periodic review of the progress by management. Friends, these financial statements are required to the business entity for taking its decisions, for government legislatures, for public, for consumers, for shareholders, and entire benefited groups who are directly or indirectly involved in that business. It includes creditors, it includes laborers, it includes bankers, it includes shareholders and prospective investors, like that. When we say the term financial statements, as we know, two statements are there. One is vertical balance sheet and second is vertical income statements. First of all, we are going to see vertical balance sheet. Now, when we say balance sheet, there are two sections in the balance sheet. One section is of sources of funds, which include equities and liabilities. Another section is of application of funds, which includes assets. Now, let us go towards first section. First section is of equity and liabilities, and it includes two major heads. One is shareholders fund and other is borrowed funds. Now friends, shareholders fund means what? Shareholders funds are the funds of the owners of the business. Now, owners of the business are shareholders. The shareholders funds includes two subheads. One is share capital and other is reserve and surplus. Now, when we say share capital, it is own fund of particular organization. It is organization's own fund and it includes equity share capital as well as preference share capital. Equity share capital is such capital, such shareholders who are not having preference in repayment of capital as well as payment of dividend. Many times, equity shareholders may not get dividend if there is no sufficient profit, because there is no provision that dividend should be given on equity share capital. In case of preference share capital, preference shareholders are having preferential right of getting dividend as well as getting back their capital on dissolution. Now, these preference shareholders get dividend at a certain rate which is pre-decided. Now friends, when we say capital or share capital, it is divided into authorized capital, issued capital, subscribed capital, called up capital and paid up capital. Whatever is the maximum capital of company which can raise over its lifetime, it is mentioned in Memorandum of Association in capital clause, which is also called as registered capital or nominal capital of company. Company usually does not need entire registered capital. Some part of it company raise, which is called issued capital. By deducting issued capital from registered capital, whatever remain, that is called unissued capital. Now whatever part of the registered capital company has issued, from that certain part is subscribed by the shareholders or public, that is called subscribed capital, and remaining is unsubscribed capital. Now friends, from subscribed capital, certain amount on each share is demanded by company, that is called called up capital, and the amount which is not demanded by the company from the public or shareholder, that is called uncalled capital. Now this called up capital, sometimes shareholder give response to the call, pay amount, that is called paid up capital. When that shareholder is not in position to pay, not in position to respond to the call, that is called unpaid capital. Now what we have to do is we have to see share capital. Now after share capital, let us go towards reserve and surplus. When we say the term reserve and surplus, they are the accumulated fund either kept for specific purpose, that is earmark, or may be kept as it is as accumulated profits. Now these reserves are created for specific purpose, they are specific reserves, and reserves created for general purpose, they are general reserves. Now when we say the term reserve and surplus, which items include under it? Items like capital reserve, capital redemption reserve, securities premium, general reserve, sinking fund, dividend equalization reserve, workman's compensation fund, revaluation reserve, development reserve, other reserves, etc. Now for getting shareholders fund, we have to take into consideration fictitious assets also, and we have to deduct the amount of fictitious assets from this reserve and surplus in order to get exact amount of shareholders fund. Now when we say fictitious asset, what is that? They are nothing but large amount of expenses which are not actually assets, but that amount we kept as miscellaneous expense on balance sheet asset side and going to write off over the years as expenditure in profit and loss account debit side. Which are they, or which are the examples of it? Let us say profit and loss account debit balance, preliminary expenses, share issue expenses, discount on issue of share, discount on issue of debenture, formation expenses, or certain deferred revenue expenses like that. Let us see what is borrowed fund. Borrowed funds, which can be said as loan funds or owed funds, OWED, means whatever we have taken from others. Now this borrowed fund includes two items, one are secured loans and one are unsecured loans. Now what is mean by secured loan? Secured loan means such loans against which we have kept certain security. When we issue debentures, that time if we say our machinery is a security if we are not able to repay our debenture amount to the public who have taken debentures. But when we keep deposit of someone and we are not giving any security charge on any of our asset, that time it is called unsecured loan. Now, when we say the term secured loan, it includes debentures, bond, bank loan, loan from financial institutions, etc. When we say unsecured loan, it includes public deposit, loan from directors, or loan from bank or other financial institute without giving any security, or debentures issued without any security. If such is there, that we can say as unsecured loan. So whether there is security given or not, on that basis we can say that loan is either secured loan or unsecured loan. Let us go towards total of sources of funds. When we make total of our shareholders fund and borrowed fund, whatever we get is known as total sources of fund. Now let us go towards application or use of funds. Now when we get total sources of fund, it should be always equal to what is total of application of funds. Now application of funds means use of funds we have raised. Now there are three major heads under application of funds. One is fixed asset, second is long-term investment, and third is net working capital. We will see one by one. When we say the term fixed assets, what is there? Fixed asset includes tangible assets and intangible assets. When we say the term fixed asset, it is the asset which is used for more than one accounting year, more than one normal operating cycles period, or which is used for long-term period. It may include land, building, plant and machinery, vehicles, furniture, etc. Now fixed assets are usually of two types. One is tangible and one is intangible. Friends, when any fixed asset we can see, touch, that time we say it as tangible. Certain fixed asset we can't see, we can't touch it, it is said intangible. Now plant and machinery is there, furniture is there, land and building is there, which we can see, we can touch, they are tangible fixed asset. Certain fixed asset are there which we can't see, we can't touch, like copyrights, goodwill, computer software or license, they are called intangible fixed assets. Further, tangible fixed asset we can divide into tangible movable asset and tangible immovable asset. When any tangible asset we can move from one place to another, it is called tangible movable asset. For example, plant and machinery is there, furniture and fixture is there, vehicles are there, equipments are there, that we can move from one place to another. They are tangible movable assets. Certain assets we can say as tangible immovable assets. Those are tangible assets, we can see, touch, but we can't move them, so they are immovable. For example, land, building, oil well or mine, we can't move from one place to another. They are called tangible immovable assets. After fixed asset, let us go towards investment. Now, when we say investment, it is long-term investment. Now, which items include under this head of investment? Let us see. It includes government securities, shares, debentures, immovable properties, capital of partnership firm, long-term loan given, sinking fund investment, etc. Now friends, when there is short-term investment, tradable investment or trade investment, it forms part of definitely current assets. It should not appear under long-term investment. Now let us go towards net working capital. Working capital means what? Working capital is nothing but whatever capital we are using to finance our current assets, to pay our current liabilities, or the capital which we are using for our operating cycle purpose, that is called working capital. Now, net working capital means what? Whatever is the total of our current assets, loans and advances, from that if we deduct our current liabilities and provisions, whatever we get is nothing but our net working capital. Now when we say current asset, what is current asset? Current asset is nothing but it is expected to realize within operating cycle period. It is called current asset. What is current liability? The liabilities which we are going to pay off within operating cycle period. That is current liability. It is usually for 1 year or for one accounting period. Now friends, these current assets, loans and advances we consider that time when we say the term current asset. Which are the current assets? Stock is there, cash is there, bank balance is there, debtors, bills receivable, all these are current assets. When we say current liability, what it includes? It includes certain items like creditors, bills payable, outstanding expense, income received in advance, bank overdraft. They all are current liability. Further, current assets we can divide into two parts. One is liquid asset and one is non-liquid asset. Liquid asset is also called quick asset. Non-liquid asset is also called non-quick asset. Now friends, the assets which can be converted into cash easily are called quick asset. On the other hand, the assets which cannot be converted into cash quickly are called non-quick or non-liquid assets. Now, which are quick assets? Cash, bank, debtors, bills receivable, current investment, accrued income, all these are quick asset or liquid asset. Now when we say non-quick or non-liquid asset, they include inventory or stock, prepaid expenses, advance taxes paid. These are non-quick assets, or advance for goods we have taken, that is non-quick asset. We can't convert it into cash easily. Let us go towards another part, that is current liabilities. Current liabilities can be divided into quick liabilities and non-quick liabilities. Liabilities which can be paid off in cash easily, faster way, that is quick liability. The liability which cannot be converted into cash, cannot be paid in cash easily, faster, that is known as non-quick liability. Now which are the quick liabilities? Creditors are there, bills payable is there, or advances received is there, expenses payable is there, accrued interest, all these are quick liabilities. When we say non-quick liability, which are they? Bank overdraft or income received in advance, these are non-quick liabilities. When we say provisions, they include provision for tax or unclaimed dividend, which also appears there. So these are all the items from current liabilities and provisions. Now friends, when we say application of fund, it includes total of fixed asset, total of investment and net working capital. Now total application of fund should always tally with total sources of fund. That time we can say our balance sheet or position statement is tallied. Now let us go towards vertical income statements. Friends, when we say vertical income statement, what is there? Let us see. In vertical income statement, gross sales we have to take at first. Gross sales includes sale of goods as well as sale of services. It is nothing but revenue received from our operations. In order to calculate net sales, we have to deduct sales return from it. Now what we get is our net sales. Now from net sales, we have to deduct cost of goods sold. Friend, when we say cost of goods sold, it includes many things. It includes raw material, it includes labor, it includes expenses, it includes factory charges, etc. etc. Let us see what include in this cost of goods sold. Cost of goods sold first includes cost of material consumed. How it is calculated? We have to take opening stock of raw material, we have to add purchase of raw material, we have to add carriage, freight, octroi, import duty paid. We have to deduct closing stock of raw material. What we get is cost of material consumed. Then we have to take direct wages, direct expenses, factory power, factory salaries, factory repairs, factory rent and taxes, depreciation on machinery, factory building depreciation, etc. etc. Whatever are the factory expenses that we have to take. After deducting all these things, what we get is gross profit. Now friends, this gross profit is very much important for us in order to know our gross earnings or trading earnings. Now, from this gross profit, we have to deduct three types of expenses which are known as operating expenses in order to arrive at our next level, that is, we can say net profit before interest. Friends, when we say operating expenses, what is meant by it? Operating expenses are the expenses incurred in course of normal conduct of business which are related with business activities. Friends, these operating expenses includes three types of expenses: administrative expense, selling and distribution expense, and finance expense. Now, when we say administrative expenses, these are the expenses relating to general office administration of organization, which include staff salaries, printing and stationery, rent rate taxes, insurance, postage and telegram, telephone charges, directors' fees and remuneration, depreciation on office furniture, legal charges, auditors' remuneration, etc. etc. When we say selling and distribution expenses, these are the expenses incurred for the purpose of increasing and maintaining the sale, distribution, and delivery of goods. They include salary of sales force, traveling expense of salesman, showroom expense, advertising and publicity, free samples distributed, maintenance of delivery van, depreciation of delivery van, warehouse rent, repair maintenance of warehouse, commission of salesman and agent. All these expenses are included here. The third category from operating expenses is nothing but finance expenses. Now, friends, when we say finance expenses, it includes cash discount to customers, bad debts which are not normal, bank charges, bank commission related with finance, related with cash disbursement, related with financial activities. They are all finance expenses. After deducting these operating expenses from our gross margin or gross profit, what we will get is net operating profit before interest. Friend, from this we have to deduct interest paid, and this interest paid is also known as finance expenses. Friends, when we are taking finance for our business, which is shown under borrowed funds or owed funds like debentures or loans taken, on that, for servicing that, whatever interest we have to incur, we have to pay, that comes under this interest paid or finance cost. It includes interest on debenture, interest on bond, interest on bank loan from financial institution, interest on public deposits, interest on short-term loans. All these appear under finance cost or interest paid. After deducting it from net operating profit before interest, we get net operating profit before after interest. Now, from this net operating profit after interest, two adjustments we have to carry out to get net profit before tax. They are, we have to add non-operating incomes and we have to deduct non-operating expenses. Friends, which are non-operating incomes, or what is meant by non-operating incomes? Friends, when we are getting certain incomes from activities which are other than our operating activities, they are called non-operating incomes. It includes dividend on shares, interest on debenture and loan, profit on sale of fixed asset, profit on sale of investment, compensation received, royalty received, share transfer fee received. These incomes received from such activities which are not our normal operating activities, so they are known as non-operating incomes and they are added in net profit, net operating profit after interest. We have to deduct non-operating expenses from this net operating profit after interest. Now, what is mean by non-operating expense? These are the expenses which do not relate to our day-to-day conduct of business or whatever operating activities we are carrying out. With that, these expenses has no relation. It includes loss on sale of fixed asset, loss on sale of investment, compensation paid, fine paid, penalty paid, fictitious asset written off. All these are non-operating expenses and they we have to deduct from net operating profit after interest. After adding non-operating income and deducting non-operating expenses, we get net profit before tax. Now we have to deduct our tax from this net profit before tax in order to arrive at net profit after tax. Friends, from net profit after tax, we have to deduct certain appropriations. Appropriations are such items which are nothing but certain parts of our net profit which are kept aside for some earmark purposes, maybe for our future use, maybe for servicing certain things like that. It includes transfer to certain reserves or earmarking certain profits like that. Now friends, after deducting these appropriations from net profit after tax, what we will get is nothing but our retained earnings. They are transferred to the balance sheet and shown under reserve and surplus in our balance sheet. Friends, we have seen what is mean by financial statements, which are the financial statements, how they are useful to different stakeholders, vertical financial statements, vertical income statement, vertical balance sheet, different items under different heads in the financial statements. We are going to stop here. Thank you.